Should we start? The first sales variance here is sales price variance. Price variances are always the difference between the standard price and the actual price applicable for the actual quantity. So the same is the case here also. The actual number of units sold into the difference in the selling prices. So we have a question in the exam kit, we'll take it up. But what are the reasons for a variance in the sales price variance? Higher than expected discounts. They have given more discounts. Therefore, what they have decided to be as the standard selling price and the actual selling price. So in reality, they were forced to give a discount or something. You must have observed that sometimes when discounts are offered during special seasons like festive seasons and all, we see that that trend catches up with every business. Sometimes when the mall is giving a discount, see, some of the brands, when they have their own showroom, there is no discount available there in the showroom. But here in the mall, because as a outlet in the mall, they are compelled to give a discount. So sometimes those are the regular day-to-day events which happen. We see that, or sometimes the order is big and then they are forced to offer a discount to them. So if what they have anticipated, what actual price which they have offered to the customers, if it differs, then there would be a variance because the difference is in the prices, standard price and the actual price. Lower than expected discounts, that could be another thing. They were prepared to give a discount, but there was no situation which has arisen for them to give a discount. The effect of low price offering due to a marketing campaign, unexpected price increases or cuts. So that is the first one. So did we work out any question? I don't remember doing. Did we? Please highlight that. Am I audible?
Sales.
Did we work out any question on sales variances? I don't remember doing anything. I said we will take it up later on. We didn't. It's not there in the Excel sheet.
And we've only done till 54, then we went to 63.
That's right. So we didn't do. Let's see this one. We have 55 and 56, both of them related to sales. So I'll copy this and then put it in the Excel sheet. 55 says that Z sells PCs that it purchases through a regional distributor and extract from its budget for the 4-week period ended 28 March 20x8 shows that it planned to sell 600 pieces at a unit price of 500, which would give a contribution to sales ratio of 25%. Actual sales were 642 pieces at an average selling price of 465. The actual contribution to sales ratio averaged 20%. What was the sales price variance to the nearest? So let me put these two questions. Okay, the details are given to us, and 55 sales price variance is equal to the difference in the selling prices applied at the actual quantity. So actual quantity of sales which took place, actual quantity all three variables are known to us. That is actual quantity is 642 pieces, standard selling price is 500, but they sold it at 465. So is it a favorable or an adverse?
Not partners.
Right?
On the budget, it is more.
One second. So we got this as 22,470. It would be adverse. Why would it be adverse? Because this is revenue. These are revenue variances. So in a revenue variance, their performance should be better than what was planned. So they should exceed, at least they should reach the standard or go beyond that to be favorable. Okay, so the selling price, they were able to sell it at 465. When they decided to sell it at 500, they were able to sell it only at 465. So on that note, we see that it is an adverse variance. Next question 56. The next one is about volume variance. Volume variance, like the quantities, the actual quantity, the standard quantity difference has to be calculated, applicable at the standard selling price. So that is the formula in case of sales volume variance. What could be the reason for an favorable or an adverse variances? They were successful or unsuccessful in terms of selling what is the standard quantity. So they might have sold more number of units than what was decided, or they might have sold less number of units than what was decided. Then successful or unsuccessful marketing efforts, unexpected changes in customers' needs and buying habits. Therefore, the impact was there on the demand. Failure to satisfy demand due to production difficulties, higher demand due to a cut in selling price, or lower demand due to an increase in sales price. So because the focus is on the quantities, so what the quantity, what was planned to sell and what actually was sold. 56th question. sales volume variance is equal to the standard selling
I have a question. Ma'am, ma'am,
yeah, one second. I'm really sorry about it. Um, where am I? Yeah. Uh, yes.
ma'am, is there a difference between sales volume variance and sales volume contribution variance?
There is a difference. Um, See, these variances, if they are following absorption costing considers the total cost and the total revenue, but marginal costing focuses only on the marginal cost. Therefore, in such situation, wherever selling price was taken, there it would be taken as the contribution margin. So that when we when we are doing that, I will definitely explain that part of it. So it is about which method of costing are they following. So it all depends on the method of costing. If the question is very specifically addressing that, that is based on the absorption costing or that is based on the marginal costing, then the variables which we include into the formula, they differ.
Okay.
It says Z sells PCs that it purchases through a regional distributor and extract from its budget for 4-week period ended 28th March 20x8 shows that it planned to sell 600 pieces at a unit price of 500, which would give a contribution to sales ratio of 25%. Actual sales were these things. The actual contribution to sales ratio averaged 20%. What was the sales volume contribution variance? So in that case, because they're highlighting now, the same set of data is there for the previous question also, but the question was only basically about the selling price. So we did not come down to the contribution part of it. We have taken only the selling price, the difference between the selling price, and then the variance was calculated. Now here the impact is on the the quantities which were planned to sell, the quantity which were actually sold. So when we are finding out the difference, because here it says that um, they are mentioning about the contribution margin ratio. So indirectly it is addressed that they are following marginal costing. So marginal costing, then they depend on the controllable profit or the contribution. So we need to consider that and then take it up accordingly. Fine. The details which are given are the standard quantity is they plan to sell 600 pieces, but they sold 642 pieces. So in that case, it is just not the revenue which is generated, because from the revenue the total costs also have to be deducted, because here it is talking about the contribution. We apply the difference in that and see what is the impact it is there on the controllable profit. So that is the point there. If such a thing is not mentioned to us, we only have the selling price, so we take only the selling price. If we know about what is the contribution margin, then we have to go ahead with the contribution margin. When the details are there, we need to take it up accordingly. were, did you get the material? Did you get the material, PDFs? Did you get the
I emailed them.
What happened?
I emailed them for the material.
Okay. Because from Monday we will be having 2 hours. So the whole week we will have 2 hours classes. I will share it with you. Are you there in a group? All of you?
Yes, ma'am.
Add me into that group. So after the class, I will share that. I'm putting my number here in the chat. So please add me into the group and I will share. The standard selling price is given at $500. 500 into the contribution percentage is 25%. So that should be 125. This one would be favorable. 5250 favorable. Why? Because the actual selling price is more than the standard selling price. PQR Limited operates a standard absorption costing system. Details of budgeted and actual figures are as follows. We have sales volume in number of units, selling price per unit, variable cost per unit, total cost per unit. The favorable sales volume profit variance for the period was The details are about the selling price, the variable cost per unit, the total cost, and favorable sales volume profit variance. So when we have the variable cost and the total cost, 5 is given, 8 is given. There are two things which are mentioned. So we need to now look into which one should be adopted. Should it be the total cost and the total profit which has to be taken, or should we go with the selling price minus variable cost? If it was the variable costing method, it would be mentioned. But what is mentioned? The first line it mentioned that this is absorption costing. So though details are given about variable cost, total cost, we need to first understand which method of costing they are following. So accordingly, let's very specifically write what the formula is. The formula here will be total profit, not the controllable profit, not the contribution margin. So here, standard profit per unit into sorry. So some phone call which is urgent, we have to attend. There is okay. Sales volume profit variance is equal to standard profit. In bracket, we have the standard quantity. This is the volume minus the actual quantity. The profit part of it will be the standard selling price is 10 minus the total cost is 8. This is applicable for the standard quantity, which is standard volume is 100,000 minus 110,000. Is this favorable or adverse? It is favorable. Anyway, it's also mentioned. It is favorable because the number of units sold are more than what was planned. So 100,000 minus 110,000.
Ma'am,
Yeah, yeah.
ma'am, actually I have a doubt in the previous sum, ma'am. Ma'am, I didn't understand why it is favorable, ma'am, in the previous sum,
Uh-huh.
56.
Why favorable is they decided to sell it at 600, but they sold it at 642. More, no? The selling price is 600 they planned.
Okay,
Instead
ma'am.
of selling it at 600, they are selling it at 642. So therefore, it is favorable.
Oh, in this case, we have to look at the output, ma'am.
Output. These are reverse to the cost variance. This is revenue, no?
Yes, ma'am.
The actual revenue, if it is more than the standard revenue, then it is favorable.
Okay, ma'am. Thank you.
But otherwise, cost variances, all cost variances, cost should be within the limit. The actual cost, if it is less than the standard cost, then it is favorable. Otherwise, it's negative. Here it goes the other way around. Sales variances are the other way around. So we have to check that whether they have crossed the standard revenue.
Okay, ma'am.
An audit firm budgeted to provide 60 audits in the next month at a fee of 6,000 each. It actually made total sales of $365,400 from 58 audits. To the nearest dollar, the favorable sales price variance. The actual sales value is already given. Price variance is the difference in the prices, the standard price, the actual price, applicable at the actual quantity. So actual quantity into so sales price variance, it talks about the difference in the prices, the standard price and the actual price. The standard price is given to us as 5,000 each. So um, actual quantity into the standard price minus actual price. That's the formula. Actual quantity into standard price minus actual quantity into actual price, isn't it? So if we elaborate it, it looks like this. It would be actual quantity into actual price value is already given to us as 365,400. The second part of the equation is given. The first part of the equation, we have to take the actual quantity into the standard price. How much is the standard price, which is given to us as $6,000 each? So we just have to find out that and check what is the variance. Sorry, it was on mute. It is 17,400 favorable. A manufacturer has the following standard information for its audit services. We have standard selling price, standard contribution, standard profit, marginal cost. During the year, it produced and sold 60,000 units. Budgeted production and sales was 65,000 units. The firm uses a marginal costing system for determining variances. What will be the value of the adverse sales volume variance for the year? There's no mention, no? No, sorry. The firm is using marginal costing system. I was looking in the first line. Since they are using marginal costing system, we should go with the contribution. We should not go with the profit, the total profit, but we should go with the contribution, standard contribution. Sales volume variance is equal to standard contribution into standard contribution is given to us as 20. The difference in the quantities are the actual quantity is 60,000 units and standard is 65. So let's put it as 65,000 minus 60,000. It is adverse, right? Because they sold less number of units than what was initially planned. The question is asking us about mixed variance. We have not done even one single mixed variance also. What is the concept of mix? So the concept of mix is when it is not just one product. In case of cost variances, the mix variance would be a combination of inputs in case of material. Instead of using just one material and then getting the output, In case of labor, instead of using only one type of labor, one skill set of labor, they go in for using multiple skill sets like skilled, semi-skilled, unskilled. In case of material, different types of inputs, that is material X, Y, material Z, something like that. So multiple inputs are used to get the output. So when what is planned to be the input in case of standard, and whether it is in the same proportion. Let's say that there are two inputs which are used. So these two inputs, which they, if they are to be used as 50%, 50%, while using it, if they have while using it, they have taken anything like 40%, 60%, then there is a change in the mix. But the syllabus is not addressing the mix variances in case of cost. What is addressed here is about the sales variance. The sales variance, which is given here as there are two products which are sold. So it is not just the sale of one product, but two products. During a period, Jones had the following budgeted and actual sales. Product A, product B. Sales budgets are given, actual sales is given, standard profit per unit. The total favorable sales mix profit variance for the period is when they are selling two different products, product A, product B. Then the number of units are given. The standard number of units, the actual number of units. The standard profit is given. So when we are talking about volume, the volume is always multiplied at the standard price. So the standard profit per unit is given. So we need to find out what is the standard cost of the standard quantity, the standard cost of the standard quantity minus the standard cost of the actual quantity. Anything is applicable at the standard rate only. The volume variances are always at the standard rate, standard profit, standard contribution. So that is what how it is taken into consideration. So since we have more than one product, maybe we can tabulate the data to find out what is the standard cost of the standard profit of the standard mix minus the standard profit of the actual mix. So that is how we can find out. So there are two products, product A, product B. Let's mention the standard quantity, standard units or budgeted units. Budget units are mentioned as for A it is 800, B also 800. Then we have the actual units are also given. 750 and 700. The other details what we have are the standard profit is given. Standard profit is 5 and then 3. We need to find out what is the standard profit of the standard output. Then we have to find out what is the standard profit of the actual output. Fine. find out the difference. The standard profit of standard output is given. The standard profit of actual output is also given. The difference between these two, I'm really sorry. I'm sorry about it. We have to find out the variance individually. It cannot, because one of them, in case of product A, we see the standard profit is more than the actual profit. Both of them, it is like that only. The actual, but it is saying that it is a favorable sales mix, no? Favorable sales mix. Here, the standard profits are more than the actual profit. Where did I miss? I have to make an adjustment here. I'm really sorry about this one. The point is, the quantities are not same, that we can take it for comparison on the same level. The quantities, the total quantities are different. We see the budgeted quantities at 1600, the total actual quantities at 1450. They are not on par. So the budgeted units have to be revised budgeted units. So revised budgeted units should be adjusted for 1450. Let me put it here. Revised budgeted units. That has to be adjusted according to the actual units. Actual units are 1450. That's the first mistake I made. Then, if that is the case, this 1450 should be in the ratio of this. So, equally, they have to be mentioned. Equally, they have to be mentioned is because they are in the ratio of 800 and 800, 1 is to 1. So, 1450 divided by 2 into 1 by 2 into 1 by 2. So here also it is 725. Now the rest of the calculation, but here it will be the standard profit of revised standard output. It is not just the standard output. It is revised standard output. So we will have this one as 725 into 5. Then here it will be 725 into 3. That's the mistake I made. Now check out the variances. Now it is a favorable one. Favorable because the actual profit is more than the standard profit. Or individually also we can do it. That is, find out the difference here. 365, here it would be a favorable one, which is equal to 3750 minus 3625, which will be a favorable variance. Then here it will be, this will be 75 adverse. The standards are more than that. When we add it up, it will become 125 minus 75, which is equal to 50 favorable.
Ma'am?
Yeah.
Ma'am, we are dividing 1,450 as 1:1 ratio because the budgeted units are in the ratio 800 is to 800, ma'am.
That's right. That is, in fact, actually, every time whenever there is a mixed variance, even if it is in cost variance also, when we look into the variance part of it, the comparison will be only when the total quantities are same. The total quantities are not same here. I just proceeded directly. The total quantities are 1600 and 1450. It is always that the budget is adjusted according to the actual. So the actual total units are 1450. So we are adjusting the budget to 1450 and the proportion 1:1. So we made it as 725, 725. The rest of the solution is the same. It is the standard profit of revised standard output. Okay.
Yes, ma'am.
Yeah. We'll wind up here for today. From Monday, we'll have 2 hours classes. Okay. So starting from Monday, um, henceforth it will be 2 hours class only. This week I had too many classes, and my another class will start in a short while. So okay, shall we end the class here?
Okay.
Okay, ma'am.
Okay, okay. Add me into the group. I'll put this Excel file. I'll put the PDF of the exam kit. Okay, and then you can also take up working these questions. Once we are done, I think in a day or two, in a day, I am assuming, because the Monday would be a 2 hour class. So if it is a 2 hours class, then I think the rest of the questions which are there in the exam kit, we will be able to finish it off. Um, then from Tuesday, we'll take it up the budgeting topic, budgeting, then decision making. Um, Decision making will go on for some time. Then risk and uncertainty. So those are the topics. You can also have the exam kit with you so that we can follow the same thing simultaneously. Okay, please add me into the group and I will share these details.
Okay.
Good day.
Thank you, ma'am.
Thank you, ma'am.